What makes a stock or a company a safe bet to invest in? Is it just as simple as tuning into Fox Business or CNBC television and buying whatever the hosts are recommending? Or maybe you should go on a forum like StockTwits and see what the trending stock is at the moment. You also can log onto YouTube and watch what your favorite content creator is buying. The one thing I will say regarding these ideas is whether they are right or wrong, you should always do your own research for yourself. And today, I'll show you how I've learned to do that. What's up, everybody? I'm Remarkable Investors, back again with another video talking about how to find stocks, what makes a stock good and stable and reliable. I'm gonna walk through how I've learned how to do it from, the various research videos I've watched, the books I've read, and make it as beginner friendly as possible. I hope you enjoy. Stability can mean a few different things, and I'm sure the answer to this question will vary from investor to investor. For me, a stable stock is one that can weather the storm of a recession in the economy, a correction in the market as a whole, and keep the price of its stock from fluctuating too much when these situations occur. Better yet, even if the price of one of these companies does drop by a big number like 20%, the fundamentals are solid enough for said company that it can rebound and grow to greater heights than it was previously. Two examples of companies fitting into this category are Google and Amazon. Now I know what you're thinking. Those are two of the world's biggest companies. Of course, they are going to be resilient and bounce back. Okay, fair enough. So let's throw Procter & Gamble in as a third. Still well known, but not as big as the previous two. If we take a look at the price fluctuations of Google over the last few decades, you'll notice it's pretty much up and to the right. This includes the financial crisis of 2008 and the market decline of 2022. Both major pullbacks for the market as a whole, but as you can see, Google was resilient and, as of the recording of this video, sitting near all-time highs. For Amazon, you can see what looks like pretty much the same chart. Straight up and to the right, a big drop in 2022, and a massive recovery since that point. Procter & Gamble is an interesting one though. Over the last few decades, the price has generally went up and to the right, but it has had a bunch more dips along the way. You see a bigger drop in 2008, 2015, 2018, 2020, 2022, and most recently, 2025. The focus for today isn't why these companies experienced the dips they have, but what is keeping them from completely tanking and what is allowing them to recover in the manner that they are. For that, we'll have to take a quick look at the financial statements for these companies. A company's financial statements are formal records that summarize a company's financial performance and position, providing a clear picture of its financial health. The section of the financial statement I'll be using first is the income statement section. I'll be using Google to show this. There are a few things I've learned to check on these statements when looking for a company to invest into. First thing I check is the revenue. Super large companies like Google and Amazon generate revenue in the billions each year, and typically it's always increasing. That's something that I like seeing. Next, I check the gross profit and make sure that's increasing year over year also. Just a brief definition of these terms really fast. Revenue is the total amount of money a company generates or makes without anything being distributed or taken out. Gross profit is the money a business retains after subtracting the direct costs of producing its goods or services from its total revenue. There are other key things on this section of the financial statement that you can check, but the last thing I check is the net income. Otherwise known as the bottom line, net income is the amount of money a company or individual has left after all expenses, taxes, and deductions are subtracted from total income. These first three things that I check are simply to see if the company has growth potential by checking the revenue, how much they have after making their products with gross profit, and if they are profitable by checking the net profit. If any or all of these numbers are stagnant or declining, that throws red flags for me, and I tend to avoid these companies. Next is a big one, a company's debt, how much they have, and if they are capable of paying it down quick or efficiently. Depending on how a company handles their debt is a major indication of if I'll stay and research a business further or if I stop and look elsewhere. So let's analyze that now. Something you may not have known when it comes to a company taking on debt is this. They have two categories of debt, short-term and long-term. The short-term debt is debt that is due within a year, and long-term debt is debt that is due after more than 1 year. These show up on what's called the balance sheet section of the financial statement. Debt on a face value level isn't good, but certain debt-savvy individuals can use debt to their advantage. Companies are no different. Let's use Google again as an example. Google has recently took on a lot of debt as a push into AI. This debt is viewed as an investment for them and something that Google is looking to have a massive return on. Companies like Google also will prefer not to use the cash they have in reserves to fund products such as this for a few reasons. Tax benefits from the government that results in a lower cost to borrow loans is one reason. Growing the company and taking in large investments without draining their day-to-day operating cash is another reason. Two more reasons are these. In case emergencies happen, they have cash at the ready to take care of the situation. And taking on debt instead of selling shares to generate cash keeps ownership within the company. So there are many benefits, if done correctly, as you can see. With that being said, Google has a very large free cash flow amount, $64.4 billion over the last 12 months to be exact. Just a reminder, free cash flow is the cash a company has left over after paying for its operating expenses and capital expenditures. One of the uses of free cash flow is paying down debt, and Google definitely has enough raw cash to cover its debt if they need to do so. The last, but certainly not the least important thing I should mention about debt is a company's ability to pay down its short-term debt. A company's ability to cover its short-term debt shows the liquidity it possesses. This is a reflection of good management, and bankruptcy is rarely on the table. It also shows reliability for investors, like myself, that these companies can handle hard times whenever they arise. To top it off, banks look at short-term debt coverage to decide if they will lend money to companies or businesses. Companies that easily cover their debts get lower interest rates. Now, the flip side to all of this is if a company struggles to pay its bills, it's a warning sign of poor financial health and is typically reflected on the share price of the company. The last section is something that I, as a dividend investor, monitor very closely when deciding on what to buy. I brought up one of the uses of free cash flow earlier in the video, but another use is the company using it to distribute dividends to its shareholders. This shows up on the cash flow statement section of a company's financial statement. I monitor this very closely for a few reasons. Starting off, if the business that is giving out dividends has a growing free cash flow, it can pay me the dividends I expect each month or every 3 months. With the free cash flow growing as it is, this allows the company to increase its dividend payout each year, which should absolutely be the goal of every dividend investor. It also shows that the company has decent enough revenue and profit coming in that it doesn't have to take on debt to pay out its dividends. With that being said, if a company is doing that or paying out more in dividends than it makes in free cash flow, the dividends are at risk of being cut, and that's the biggest red flag as a dividend investor. This leads us to the next part of this section, the payout ratio. Payout ratio is the percentage of a company's net income paid to shareholders in the form of dividends. I look at this to see if a company is paying out a safe amount to its shareholders. You get this number by doing some simple math. You find out how much a company has paid out in dividends for a specific period, and you divide it by the company's net income or profit. Multiply that number by 100 and you have your payout ratio percentage. The lower the number, the better for me. The lower the number shows that the company is using the rest of the free cash flow money to invest back into the business, which shows me that the company is focused on growing. And a growing company is a healthy, stable company. The general consensus for a healthy payout ratio is around 60%, but it varies from sector to sector. Now, just a quick note really fast. If the payout ratio is near or above 100%, this indicates that a company is almost or is paying out more in dividends than what it is earning. Needless to say, a huge warning sign that the company is about to cut its dividend to save money. So not only does this affect your plans as a dividend investor, but the share price typically drops when a cut happens because this tells other investors that the company needs to save money in the near future, and that affects its profits. So as we come to the end of this video, I have a more personal perspective on this topic. Most of, if not all of the things I've talked about in this video, I've learned from books modeling Warren Buffett's investing strategy, YouTubers I followed, and personal research throughout the years. One quote from Buffett on this topic is this: "A good business is like a strong castle with a deep moat around it. I want sharks in the moat. I want it untouchable." Strong and durable companies do not have just one redeeming quality going for them. They have many strong features or sharks, to piggyback off of what Warren Buffett said. One I forgot to mention earlier is the stability of defensive stocks. Stocks like Procter & Gamble fit this perfectly because though they may not be the rich tech company with AI like Google or the chip company like Nvidia, they sell everyday products us as humans use in our day-to-day lives. Things like laundry detergent, toothpaste, diapers, medicine, and the list goes on. Companies like them have a stability that is durable regardless of the economic season, and there are many others like them. You just have to be patient and look. Thanks for tuning in again and watch me ramble about finances and give my perspective on certain things. If you want to watch more that are on finances or more of a religious take, religious based, feel free to watch some of these other videos I have that are part of the channel. Once more, I thank you again for taking time out to listen to me ramble. So I'm Remarkable Investor. Have a good one.